Hello, I'm Owen Schrum, founder and president of Capital View Investment Partners. We're your expert in investment and planning for retirement. Owning stocks, or at least some form of investing in the stock market, is a time-tested way to create wealth and income, and they have a really important place in the majority of Americans' retirement portfolio. There is one critical fact you have to understand to comfortably and successfully have stock investments work for you in the long term. It is not a straight line experience. The stock market does not go straight up. Over time, it really does create wealth and provides income, but it does fluctuate. It fluctuates up, fluctuates down in the process. Today, we're going to give you some facts you need to keep in mind as you use the stock market vehicles to help fund your retirement portfolio. Start with number one: corrections happen. The market will go down. It's easy to become unnerved during these periods of correction, trust me. Number two, going all the way back to 1910, 5% drops happen on average 3 times per year. Number three, 10% corrections happen on average about every 357 days. Yes, every year on average there's going to be a 10% correction. You just have to understand that. It's normal. So it's important here to distinguish between corrections and bear markets. Corrections are 10 to 20%. They last on average maybe 14 weeks, some shorter, some slightly longer. A lot of them really are shorter. Bear markets are greater than 20%, are typically associated with an economic recession. These bear markets can last a year or longer. So understand, corrections are short-lived and they can be viewed as a necessary evil. Here's some data compiled by Bloomberg and made available to us by First Trust. In this period, 1-year returns after a correction averaged over 20%. 5 years after a correction, the average annual rate of return was over 10%. So let's look at this chart for just a second. As you can see, there were only 2 years during this period that you didn't have a positive year after a correction. As you can see, again, on average, over 10% return per year on a 5-year basis after one of these corrections. So here's the takeaway. Diversified stock portfolios are an important part of retirement for creating wealth and income. Corrections happen, always. Statistics point out that net returns on your portfolio after a correction are positive both for a 1-year and a 5-year basis. Look, we hope you find this helpful. We at Capital View Investment Partners believe you should have a retirement on your terms. Until next time, this is Owen Schrum.